welcome all of you to the meeting today to Power Monday. Power Monday is a program that has been there for over 2 years, every single Monday except public holidays in Kenya. We meet from 7:15 to 8:15, but we join as early as 7 to just chat and network, catch up, and get to know each other's business. And so we welcome all of you. Power Monday is sponsored by Live Your Dream Enterprises Limited that conducts business development services, team building, corporate training, and all sorts of training. And we are always excited about empowering people, sharing knowledge that is simple, practicable, helping people to live their dreams. So all of you are welcome, and we do this every Monday. We use the same link. And now I'd like, as our tradition nowadays, to just open with a poem from our poetess, and that is none other than Dr. Lucita. You can open it up, please. Then we move on.
Beautiful Monday morning. Today we are doing a poem on Like an Ego. Not Good Morning Monday, but next week we are likely going to do Good Morning Monday. Good Morning Monday was a good one. Like an ego, it's now or never. You wear or you soar. You rise or you fall, but rather choose the earlier. Grow on your wings, crown on your claws, forget your flaws, flip your wings. It's now or never. You're made of possibilities. You should abandon all your negatives. You ride on your positives amongst all the executives. It's now or never. Look up to the rain. God is source of a rain. His word is so foreign. Blessings, he brings in showers of rain. It's now or never. Off against the storm, above the sky so firm. In praises, you should transform. In prayers, please confirm. It's now or never. Evolve with confidence. Find courage in his grace. Soar with abundance. Walk in his experience. It is now or never. You wear or you soar. You rise or you fall. Like an eagle, you rise above the storms. This is your poetess.
Thank you very much. You saw, you will live your dream. Yes, I think that is very beautiful. So at this point in time, we'd like to introduce the speaker. And maybe just before that, let me just share with you a quote about taxes. Albert Einstein said, and that is our topic for today. Yes, what you need to know, you and your business. Albert Einstein said, the hardest thing in the world to understand is the income tax. The hardest thing to understand in the world is income tax. It is income and it is tax. And then somebody said, Alfred E. Neuman, that today it takes more brains and effort to make out the income tax form than it does to make the income itself. So this is the day that the Lord has made. And so I'd like to invite Noel to introduce the guest speaker.
Good morning. Good morning. Kindly, I apologize today. I won't put my video on. Our internet is so horrible.
Go on.
Thank you. So our speaker of today is none other than CPA Rugunya, and he has a demonstrated history of working with SMEs in financial management systems setup. He is passionate about working with SMEs and startups and drivers of the economy and job creator. He is the founder and lead consultant at the award-winning Prolific Business Consultants, strong consulting, professional skilled in capacity building, training, taxation, online accounting, audits, and financial modeling. He has been featured by the global communities as one of the success stories under the USDA funded AIMS programs. A thought leader who has made several appearances on Saturday Nation and Metropole TV discussing money matters and taxation trends. One of the features entrepreneurs under the Entrepreneurship Roundtable 2021 organized by Strathmore University. He is a professional mentor with several mentorship and business incubator programs, including Synapse, TechBridge Invest, Kimilimu, and Mama Ventures. CPA Jeremy is a VP Finance at SME Founders Association and is the immediate former chapter president of BNI Eagles. Karibu sana, Mr. Jeremy.
Thank you, Noel. And thank you to each and every one of you. At times you listen to that introduction and you're wondering whether, whether you know that person. Otherwise, I'm very, very happy to be here. I think this is a space that is, it appears this is a space I'm going to love for many reasons. One of them is that I'm a poet myself. One of my poems is called "Is Zero Nothing." So probably that is what we should recite next Monday, but one is zero nothing. So
great. We will be happy to hear that.
Yes. I also do have the book club, and guess what we call it? It's called the Eagles Book Club. And lastly, my firstborn son is called Noel, so clearly I'm at home. So thank you very much. I think I would want to get into the presentation. Maybe just to be sure about how much time are we looking at in terms of
everything should end by 8:15, so that includes questions.
So that means
you can do like maybe up to 30-something minutes, but within 15 minutes, the last 15 minutes, there could be some questions. I know people will have many of them.
Okay, that's I think that's a good plan. So I believe I can be able to share my screen.
Yes, you should be.
Okay. All right. So thank you once again. CPA Jeremy is my name. I had an accounting firm, Prolific Accountants, and we are a member firm to Santa Fe Associates International, who are going by the name now SFI Global. That is SFI Global. This is one of the accounting networks in the world. We provide the services that you can be able to see on the screen. So, and when it comes to financial management, what we say is that many businesses start off without a proper financial management system. And is that a problem? We think it is, because you can't tell who owes you, who you owe. Find yourself having late payments. And to our topic of the day, if you don't have a proper financial management system, then you find that you may attract penalties. So, also why you would want to have proper books is because, and we will see how proper books have to do with taxes. But you also know that you would want to know, is my business growing? Am I doing better this year than I was last year? Am I losing money anywhere? But when it comes particularly to records or record keeping or bookkeeping and taxation, one of the things we say is that, for example, income tax is tax on profits, and profits are sales less expenses. 1 minute, I need to close that. Okay. So what happens when you can't keep track of your expenses? Then you end up reporting higher profits than what you should. Or in the event that the taxman came for a tax audit, then you find that you don't have a way to prove that you actually incurred those expenses. even though they were legitimate expenses that you incurred, but because you didn't maintain proper books, then you find that the profits that result, say, from a tax audit are higher than they should. So for that reason, it is very good that you maintain proper records. That also helps you to be able to find legal options to avoid tax. So there are two terms which at times can be very confusing. One of them is tax avoidance. The other one is tax evasion. And basically we say that tax avoidance is being able to use legal options, you know, that there are ways that you can be able to pay less tax just by being within the law. Whereas evasion is where you fail to pay by using means which are not legal, say like fictitious invoices or understating incomes and so on. So one of the things that, for example, you can be able to do to manage your taxes is to pay yourself a salary. And this is highly recommended. It's part of, you actually find that it is like a double-edged sword. On the one hand, it helps you in terms of fiscal discipline for you as the business owner. Then secondly, it also saves you on tax. And the simple reason is because when you pay yourself a salary, then it is an allowable expense to your profit and loss account. The other one is that when you acquire assets, which of course you're going to be using in the business, say such as computers, equipment, motor vehicle, and you register them in the name of the business, then you can be able to claim depreciation, although the legal term which is used in terms of taxation is capital allowances, but basically it is the same thing, depreciation. So why the difference at times is because depreciation, you may want to use a different rate for your books, but for tax purposes, there is a particular rate which you're supposed to use. So just an overview of the taxes in Kenya. So you can look at these in two ways, and this is the income tax. You can say there is the individual tax returns and there is the corporate tax returns. So for the individuals, we say there we have employees and also the sole proprietors. The tax for sole proprietors is calculated the same way as that of employees, which is on what we call a graduated scale. Graduated scale means that the first 24,000 is calculated at 10%, the next 8,333 at 25%, and anything above that at 30%. So effectively, that means that individuals pay less tax than a company, which is taxed at a flat rate of 30%. Now, what happens is that if you have employees, then you should register for and file pay as you earn. And one of the things that we say is that you should be able to carry out this test for yourself. It's called a PIN checker, which you can be able to do on iTax. And you want to know whether you have the obligations that you have basically. So for example, this is the result of a PIN checker for our firm, Prolific. You can see we have income tax, which is paid annually, but then we also have VAT and pay as you earn. And one of the things we are saying is that supposing you have these two obligations, VAT and pay as you earn, and you're not aware, what happens? Every month you're incurring a penalty of 10,000 for each. So like they say, ignorance is not defense or is not bliss. So you want to be in the know. So this is a test you can just be able to carry out by yourself on the KRA website, that is KRA PIN checker, so that you are aware of the obligations which you face as a taxpayer, or which your business faces. For a company, it is taxed at a flat rate of 30%, and we said it is 30% of profits, not turnover, where profit is sales less expenses. Then partnerships, what happens with partnerships is that tax is assessed on the individual partners. So if say myself and Noel got into a partnership, then what will happen is that at the end of the year, we will say this is the partnership profit, this is the profit sharing ratio among the partners, or between or among the partners, depending on how many there are. And then you divide the profit in the profit sharing ratio, then it is taxed on each one of us. But that is as far as income tax goes. For other tax requirements, such as pay as you earn or VAT, then you find that that you're still required to say file pay as you earn, register for VAT if you're above the threshold, which is 5 million, and so on. Thank you, Noel. So income tax is paid on what is called a self-assessment basis. And what the taxman recommends is that, say, for example, in 2022, you make $1 million profit. Then they say in 2023, assume you're going to make 110% more, that's 1.1 million. Then calculate the tax on the 1.1, which if you're a company will be what, 30%, that's 330. Then that 330 divide by 4 and pay one installment in April, in June, in September, in December. So you notice here we say that it is paid on a self-assessment basis on months 4, 6, 9, and 12. That is because the financial year for a company or a business, even a partnership, could vary from the calendar year. In which case, if, for example, so of course, if your year runs from January to December, your month 4 is April. But if, for example, your year runs from July to June, then your month 4 is going to be October, and so on. So then we have what is called withholding tax. And we say this is a situation where the payer of a certain income is responsible for deducting tax at source from payments made and remitting the same to KRA. This is done by the 20th day of the following month. And once they do that, then the system generates a withholding certificate, which looks something like this. Then what you do is that at the end of the year, you'll be able to say my income, these are my incomes, these are my expenses, this is my profit, this is the tax that I should pay on this profit. But then I have these certificates which amount to tax paid in advance. So you offset that against the certificates. Against the certificates. Then let me mention something on VAT. So VAT, we say, is a tax charged on the supply of taxable goods or services. And basically what happens in Kenya is that you're not required to register for VAT if you're below 5 million revenues. But the moment you hit 5 million, then it's a requirement that you register for VAT. If you're below 5 million revenues, you could still choose to register. They call that the voluntary registration. But then if you do, and why would you want to do voluntary registration? Maybe because your clients are demanding an ETR receipt. So an ETR receipt is a receipt obtained from an ETR machine, which is a machine you obtain when you're VAT registered. So if, for example, you have a customer who insists on an ETR receipt, then you may register for VAT. If you do, then you're required to file VAT every month. You're also required now to start charging VAT on all vatable goods or services that you supply. So for that reason, it's good to be careful. Then how you calculate VAT, we say it is VAT on sales, less VAT on purchases. Then of course the rate is 16%, except for petroleum products, which are at 8%. We remember how that 8% was arrived at. It was the result of a Solomonic judgment by the then president, because what happened was that the parliament had been putting it off for a while, and then when it fell due, there was an outcry, and so the former president said, then let's meet halfway. Instead of taxing petroleum products at 16%, let's meet halfway and just use 8%. So like I mentioned, once you have VAT, then you're required to get an ETR machine. And now what has happened is that there are new ETR machines which communicate directly with KRA. They call them the TIMS. TIMS means Tax Invoice Management System. And basically they are, you can say they are real-time. Okay, real-time or near real-time. Near real-time because it needs to be connected to the internet for it to communicate with KRA. And it means the moment then you connect it to internet, it automatically communicates. Then just like we mentioned about withholding tax, which is mostly at 5%. I say mostly because for contractors it is 3%. Then you also have withholding VAT, which is 2%. The principle is the same. You supply goods to me. If I'm an agent, I withhold. Then I issue a certificate. Then when you're filing VAT, you'll be able to offset the value of the certificate against your returns. So remember to file new returns for months in which you have no transactions. Okay, so a few tips in tax management in an evolving landscape. One we say is to be informed. This is a quote from Derek Bock of Harvard, that if you think education, or in this case we can say knowledge, is expensive, try ignorance. Sun Tzu, The Art of War, says that if you know the enemy and know yourself, you need not fear the result of 100 battles. If you know yourself but not the enemy, for every victory gained, you will also suffer a defeat. And if you know neither the enemy nor yourself, you will succumb in every battle. Now, think about that and how it applies to your business and taxes. The thing is that you want to know yourself and you want to know, quote unquote, the enemy, who I will not name because he's the elephant in the room, but we all know in this case who that happens to be. That if you don't know the enemy, and the enemy in this case will be, knowledge of the tax laws, for example, then you will succumb in every battle. You will find that you are exposed to unnecessary tax penalties. And if knowing yourself has to do with knowing your numbers, and for that, of course, we recommend being able to maintain proper books of accounts and so on. So, so this is why this is important, is because the tax laws also keep on changing. For example, now we have the capital gains tax revised from 5% to 15% this year. You have VAT on digital services, okay, which in my opinion probably does not affect us so much, because what you're saying is that if we are consuming digital services like subscriptions, say like to online accounting systems like QuickBooks, Xero, or Zoho Books, then they are charging you VAT. But then there's also VAT on export services, which has brought a lot of disquiet, because the question is, why are we charging VAT on export services or on exported services, and we don't charge VAT on exports, whereas for goods? But basically, it means that if you're exporting services, then you're not supposed to charge VAT on them. That follows a ruling, a recent ruling that you're supposed to charge VAT on export services. Then the new NSSF rates, again, this is a new ruling, actually very recent. If you know about NSSF, you had, if you know about NSSF, then you know that they gazetted the new rates, which were higher, but there was stopped the implementation. But now they are saying that the court that made, or that gave that injunction, did not have the jurisdiction. In other words, it was a junior court, so to speak. So, and of course, I think at times tax development, there is, in my opinion, there is usually what they usually follow. There's usually some influence in terms of political wins. That's my opinion. And we know that also KRA has appealed the minimum tax. So minimum tax was a tax that was going to be applicable to all businesses at the rate of 1% of gross turnover. So of course, this was shut down at Machakos, but the thing is that KRA has made an appeal against its nullification. Okay, so that's one, be knowledgeable. That's what we are saying, that you don't want to be ignorant, you want to be informed. The second thing is do not walk alone. And I like this quote from Lord Eddard Stark of the Game of Thrones. It was actually his daughter Sansa who was quoting him, that when the snows fall and the white winds blow, the lone wolf dies, but the pack survives. And what we are saying is that in winter, we must protect one another, keep each other warm, share our strengths. So what does that have to do with taxes? If, for example, you look at that case that we just mentioned about minimum tax, yes, KRA is appealing, but so far we are looking at its nullification. And how did that come about? It came about because KAM, Red Track, Senior Bus Association, and even ISPAC initially, they joined hands and went to court, you know. And if you think about it, each one of them is the gathering of SMEs. So the thing we say is that when it comes to taxes, you want to find your pack, because there are issues to do with lobbying, for example. You can't be able to do that as an SME all by yourself. So what we say is find your pack and make sure that you're keeping yourself warm. Then build relationships with consultants, with even with the taxman. You want to ensure that you're having good relationships. Then the value of relationships, for example, let's look at what is happening now, like with the new ETR machines. The moment that I sell to you and I raise an ETR receipt, KRA immediately expects that tax from me. So what does that mean? It means that as a businessman, or as a business leader, or as a business person, I need to manage the relationship very well with my customer, such that, for example, we can have an agreement that I am not raising an invoice until you're ready to pay me, okay? Because if I do otherwise, I will find myself cash strapped. So the only thing that makes sense is for me to only raise the invoice at the point where you're ready to pay me. But you see, that cannot happen in a vacuum. It has to be that I am having a conversation. And that's one of the things, of course, that we learn the moment you start a business, is that there is more to a business than just making sales. Then plan to win. I think this one, I don't need to belabor that point. Utilize allowable legal provisions. But there are always many legal provisions or provisions within the law that you can be able to use. There's the voluntary disclosure program, for example, okay, which is coming to an end though. Started 2 years ago. It was at 100%, then 50%. Now it is at 25%, meaning that this year, if you have any taxes that you had not paid, then you can be able to declare and pay them, and they'll give you 25% waiver on penalties and interest. Then there are many reliefs, such as the personal relief, insurance relief, if you have a life insurance policy or education policy that is more than 10 years. Then we mentioned about paying yourself a salary. You can register business assets in the name of the company and claim depreciation. Keep track of expenses, okay? That's very key. And one of the things that we enjoy, well, one of the things that we recommend there is that you can be able to make use of technology. Prolific, we are certified advisors for Zoho Books. Well, even QuickBooks, even Sage One, but particularly, I am of the opinion that Zoho Books is doing a good job in this market in terms of understanding this market. And that means that, for example, you can be able to track your expenses on the go. You know, you take a client out and you can scan the receipt and you immediately have it on your portal. You have it with you. You can be able to post either from mobile or web. So you want to keep track of expenses in short. So those are the things that you would want to think about. And I think I would want to cease my presentation there. Again, prolific accountants, we say that prolific accountants, because every business counts. Thank you, and back to you, Mr. Chair.
Thank you very much, Jeremy, prolific accountant. My name is Otieno Paul Peter. I remember I didn't introduce myself to you. Many people know me already. Good to have you. And I posted this flyer somewhere, and people were, we'd like this guy to come to. There are enough Rotary clubs around, and some people would like you to speak to their clubs. So we'll share your contact. Now, people can raise questions. There is one question that came about the first one from Udoni. What tax applicable? What tax is applicable to limited by guarantee companies? And is it a true non-profit, not for profit, something like that? You can maybe start with that.
All right. Thank you. And thank you, Muthoni. Okay, so when it comes to, basically to all non-profits, and yes, the company limited by guarantee is viewed as a not-for-profit, which means that, I mean, if you already obtained the registration, you even had to have vetting by DCI and so on. So what happens is that for a company, for all non-profits really, not just a company limited by guarantee, there are some taxes that you still, or some tax obligations that you still have, that you still liable to, such as pay as you earn. You know, if you're having employees, for example, you're still required to file pay as you earn for them, to file NITA. I forgot to mention about NITA. It's 50 bob per employee per month. You're still required to file an HIF and SSF. If we provide audit services to you and our invoice is above 24,000, you're still required to withhold tax at 5%. But then when it comes to your income tax, you would say that whatever you have as your profit or your surplus, then that should not be subjected to tax. However, it doesn't just automatically apply that it's not going to be subjected to tax. You need to apply for what is called a tax exemption certificate. But the idea is that you being a not-for-profit organization, then you should be able to obtain that from KRA. I hope that helps, Odhani.
How do you get that tax exemption? And now the other thing is, what do you mean by every employee is charged NITA? How does that come in?
Okay. Yeah, I mentioned two things there. So NITA is a National Industrial Training Authority. And the fact of the matter is they've been around for a while. And basically they say their mandate is to have a trained workforce in the nation. So the thing is, they've been there, and it's been a requirement that every employer pays an amount towards the National Industrial Training Authority. However, they have not been very successful in collections, and so what they've done is that they have now approached KRA, or they have joined hands with KRA so that KRA can be able to collect the levy on their behalf. So that means that as you file the pay as you earn every month, then you're also required to file NITA alongside it. So the envisioned benefit of you paying NITA is that you can be able to apply to the authority to get refunds on training for your staff. But then the two conditions are that, number one, you need to be up to date with the NITA contributions. And number two, that you apply for approval of the training beforehand. Then once they approve that, you can be able to get a refund for the training expenses of your employees. What's the other question, Otieno? Sorry.
Yeah, no, the other question was the process of acquiring tax exemption
Oh, the tax
certificate.
exemption. Yeah. So that you're okay. You start by applying it on the iTax portal. That's where the process starts. But then you have to follow up with KRA at whatever your station is. And to be honest, it can be a bit laborious. Of course, they don't want to make it easy for you to say that you're not paying tax, because you have to submit a number of documents, including audited accounts, a tax compliance certificate, even a letter from the chief. Can you imagine, of the area where your business operates? Some of these laws. Anyway, maybe that's why we need to team up and lobby for their change.
Yeah.
So that is basically the application process. You initiate it on iTax, but then you follow up with your station. They come for a visit. They want to see the activities that you are engaged in and to see that they actually meet the criteria, which usually is it needs to be for the advancement of education or alleviation of poverty. So that's what they say.
Thank you. Now there is another question before I see Rajwai asks his, how many times can you file a nil return if your company has not done business for a long time? Very little transaction of less than 200,000 annually.
Okay. So first, let's establish that a nil return means that you didn't have any transactions at all. In fact, when you attempt to file the new return, the system automatically gives you that message that you're about to file a new return. That means you didn't have any transactions at all. If you have, and if you have no transactions, then you can file what? In perpetuity, you can file eternally. You can continue filing, and even if you're not there, your estate continues filing, So there is no limit if indeed you're not in business. What happens, however, is that if you have a few transactions, you should be able to account for those transactions. If there is no profit on them, then you just declare it as a loss, which is carried forward to the next year. So, and at times we confuse between a nil return and a credit return. A credit return meaning that you don't have any tax to pay, so you're lodging a credit which is to be carried forward to the following year. So if you have very few transactions, the correct thing to do is that you should be able to account for those and just file. The Companies Act 2015 removed the requirement for audited accounts for what we call small companies. Small companies are companies with less than 50 million revenues, less than 20 employees, and there's a figure for assets which I don't remember. But if you're below 50 million, then you don't need audited accounts for you to file the returns. Meaning it's something that you can actually learn to do yourself and just file even without the services of guys like us. But if you have no transactions at all, then in that case, you can do new returns. And what happens, of course, is that if you ever find yourself having a conversation with the taxman for one reason or another, such as you applied for a tax compliance certificate, or you want removal of one obligation, or whatever other thing, then the thing they say is that give us your bank statements. Let's see that indeed you didn't have any transactions for the periods where you claimed or where you filed nil returns.
Thank you. Now, maybe before I read the next one, yes, John Rajwai, you can ask.
Hi, I'm very happy with this presentation. It's really an eye opener, and the issue of agreeing with a client or with the person who's supposed to pay you on the time to raise the invoice so that the tax is due when actually you have been paid. It's easier said than done, and especially for government institutions and the county government, because we realize, especially the small farms who are still trying to get their feet. and you do some job, say for the county or a contractual job or a consultancy, and you find that they withhold already. So when KRA sees that withholding tax even before you get paid, they're out there demanding for payment. How can you probably go around this? Because you find that now you have a lot of tax obligations, whereas the actual monies that you have received is zero. Thank you.
Thank you, John. And when it comes to say the county government or parastatals, it's true that it may be difficult for for those to convince them to pay you before you have issued an ETR receipt. But I think that boils down to, I think that is beyond, that is more than tax. I think the correct word is more than, I think that is more than tax. I think that is part of the challenges we face as business people, myself being one of them. And it boils down to what we call working capital management. Working capital is how the management of your receivables, that's your customers and the monies that they owe you, versus your payables, that is your suppliers. And that is usually driven by, if you know of Michael Porter's 5 forces, he talked of 5 forces, and 2 of them are customer power and supplier power. So ordinarily the question is, how much power do I wield as a customer vis-a-vis this supplier, or as a supplier vis-a-vis this customer? Because it's the same challenge you find, for example, with guys who supply to supermarkets, you know, that you will supply and you take forever before being paid. So, and I think the first step is acknowledging that there's a challenge, there's a problem there. Then to ask whether this is my ideal client, then what are the options around that? Do I want, for example, to consider options such as invoice discounting, or even LPO financing, but especially invoice discounting, if you can be able to find, then that may be a good answer. But you notice that that has less to do with taxation and more to do with cash flow management. That's my take on that, John.
Thank you. Yeah. And there is another question. Maybe you had alluded to this, but just for the sake of clarity, if you are not registered for VAT and you supply goods, how do you account for VAT?
Okay, well, if you're not registered, then basically it means that it goes to you as a cost. Yeah. Because if for example, so of course, if you're not registered, number one, you don't charge, that's the thing. But if you bought and your purchase had VAT, then it means that to you, the whole invoice is a cost to you.
Okay. A cost to you means what? You pay it
all right.
to...
Okay. All right. Thank you, Otieno. Let me do this. Let's assume just 1 minute. Let's assume that I'm going to make a sale, and my sale, whatever, I don't know what I would be selling. Yeah, let me just use my business here. And let's say that when I sell, ordinarily I will sell at say 1,000, and then I will charge VAT of that is 160. So my invoice is going to read 1160. And let me assume that whatever I sell, I bought. Okay, I bought it, say 400, but the person who sold to me also has VAT. So they sold to me at 464 instead of 400. Okay, so my sales ordinarily will be 1160. My purchases will be 464 because I am registered for VAT. So what happens, and what that means, by the way, what that means is that if I don't make this sale, or sorry, this purchase, then the VAT that I would pay is the entire 160. The entire 160 is what I would otherwise pay. But the moment that I buy from this person, then what I paid to KRA becomes the difference, which is 160 minus 64, which becomes 96. And this is why you will find people saying, you know, when they buy, they want the ATR receipt. This is the reason that, for example, some people don't really mind, I being one of them, if I'm going to, for example, lease an office somewhere and they say the rent is 40,000 plus VAT. To me, I know that VAT I'm going to offset against my sales, so it is not a problem. So we have two people, for example, in this case, and let's assume that the two people are myself and Otieno. And we both take an office, 400, let's assume that was $400, so it's 40,000. We both take an office whose value is 40,000, okay? So plus VAT, so we both pay to our property manager 46,400. I am registered for VAT, Otieno is not. What happens? To me, who is registered, the 6,400 I am going to offset against my sales, which means effectively my cost is only 40,000. But to Otieno, who is not registered for VAT, the entire 46,400 goes to him as a cost. He has nowhere to offset these 6,400. That is what we mean when we say that to you, it is a cost. I hope that helps to clarify.
Thank you. Thank you. I know there are people, when you start doing figures, they feel dizzy, but it's okay.
Oh my. Noted, noted.
Thank you very much, Jeremy. What are the tax obligations for a CBO?
All right. So a CBO will just be the same as what we mentioned for the company registered by, or company limited by guarantee. We said that when it comes to the income tax, then the income tax should be exempt from taxation. And how you ensure that that exemption is by obtaining a tax exemption certificate. But then if you have dealings with, say, suppliers, and these suppliers, they supply services on which you should withhold tax, then you're required to withhold tax. Same as your employees, you should ensure you're filing whatever returns for them. So you don't pay as a CBO, no matter no matter the money coming in, your inflows, you never register for VAT, for example. So we will say that when it comes to, since you're not trading, then the taxes that would apply to a trading company, which is mainly income tax and VAT, then you don't have to register for VAT. And then for income tax, you obtain a tax exemption. But where you are dealing with other parties in which you're supposed to collect tax for the government, such as employees and service providers, then you're required to do that.
Thank you. Yeah, and then next question, we are running out of time, but I hope we will be able to answer these three. One is, good morning, I joined late. If one has a cosmetic shop which has been closed for 2 years, is she supposed to pay taxes and they don't even have a bank account? It's a small one. It's a small business. So one, they've not been operating for 2 years. Two, it's a small shop. I don't know whether it has products or items. I think that's the question. Is there any tax obligation?
Thank you, Mercy. And the thing is that if you've not been trading, then you really don't have any tax to pay. If you've not been trading, you have no tax to pay. The only thing is, which we mentioned at the start, you want to know which obligations you have, so that, for example, you're not incurring penalties on VAT and pay as you earn, because you're supposed to file nil returns for all the obligations that you have, even when you're not trading. Otherwise, you can apply for dormancy. That is also something that you can do. You can say, well, for the next foreseeable future, I may not be in business, so I'm applying for dormancy, either dormancy of the PIN or dormancy of a particular obligation. You know, like I don't have employees now, I used to. I may have them after 1 year. So for now, I would like to request that the payee obligation is made dormant. That removes the obligation to have to file every month.
Thank you. Now, another thing, remember to put your contacts there. People
All right.
will want to ask more questions along the way and even maybe seek your services. And Dr. Melvin has asked something to do with capital gains. How is it calculated on land, land sale?
Okay, so capital gains, it's simply the tax on the gain. So you will simply say, how much did I sell this land for? What was the cost of purchase or acquisition? You know, however you acquired it. Assuming you bought it, then you will say, I'm selling it for say 10 million. I bought it for 5 million, so that's a gain of 5 million. However, you also less expenses that are related to the land transactions, say such as legal fees. If maybe you paid a commission for someone to find you a buyer and so on, you're able to offset the expenses that are related to that transaction. So it's simply being able to say, what is the gain on that transaction? Then now that is what is taxed at 15%, previously 5%.
Thank you. Now, a very good question and interesting from Christine. What are some of the innovative ways or legal tax avoidance measures SMEs can use to keep more cash in their pockets? Can we pay a lot of, can pay a lot of taxes? Yeah, people can pay a lot of taxes and don't receive much. Yeah, that is the idea. So you are spending a lot, but then how is it possible? In ingenious ways.
I think one of the best ways, and which is you know, just right before us, it is so simple that at times we ignore it, is actually proper record keeping, tracking of all your expenses. Because trust you me, especially if I mean, myself, I'm in services. Services are not as capital intensive as products, that is good. And yet I see how tracking all expenses, how little profit that retains, if at all, for me to be able to pay any tax. So tracking expenses is one of the things, or proper record keeping is one of the best ways that you can be able to ensure that you're not paying more tax than you should. But then we mentioned a few others, such as being able to claim capital allowances by having the business assets registered in the name of the business. We talked about things like paying yourself a salary. We talked about taking advantage of reliefs which are there, such as insurance relief, relief on life insurance and education policies. So those are things that you can be able to do. Of course, at times you also just look at case to case, and you're able to see which is the best way. What's the best way to avoid tax? Like one of the things that, for example, I have seen discussed. Of course, it's a new regime, so these discussions are coming up. But there's something called the investment deduction, which is given to manufacturers if they get, if they buy manufacturing equipment, which is 100% within Nairobi, but 150% outside of Nairobi. So you see, just by positioning yourself, say, in outside Nairobi as a manufacturer, you could have a higher tax rebate. Or say positioning yourself in like what we call, if you are an exporter, in an export processing zone. So there will be those things that also may be specific to a business, but generally it all starts with you know what we said, know yourself, know your enemy, and know yourself is proper financial management, and knowing the enemy is keeping abreast with the laws. Thank you.
Thank you very much. Yeah, I think that's great. The other question there has been answered in some way about that's exactly what John Rajuai had asked. You get LPOs lasting 30 to 45 days. And when you raise an invoice, immediately the government requires money. So that had been discussed. And if you need more explanation, you can always reach Jeremy there down. Now, I think at this point in time, I'd like to ask one of us to give a vote of thanks. Dr. Melvin, are you there? You can give a vote of thanks to our friend Jeremy. I hadn't seen you. Please give a vote of thanks. Give a vote of thanks to our friend Jeremy.
Good morning. Thank you very much, Jeremy, and everybody else who has attended. It has been a very, very useful opportunity to come face to face with the elephant in the room called taxation and all that goes around. I like the way you have simplified it so well. Some of us who didn't do very well in maths and kept away from anything to do with maths, at least now we understand about taxation. And I think we'll make arrangements now that you have your contacts to meet you behind the tent of Nairobi for more details. But for now, thank you very, very much. And let us continue sharing all this information. We have these institutional memories as professionals, and let us not be like the person who took a candle and put it under a table. We should take that candle, put it on top of the table, if not go to Mount Everest and put it up there and let the world know that this is, get that knowledge. So thank you very much, Jeremy, and be blessed. For the rest of us, we have a blessed day, have a blessed week, have a blessed month and year. Thank you.
Thank you. Thank you very much. Thank you. Thank you very much for thanking him. And we are happy and grateful. Now, just a final remarks.